Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, October 11th. We got some important data on the calendar today, so we're going to go right into it. Of course, we get the weekly jobless claims as we do every Thursday. As you can see, last week we had a pretty good number here at 207,000. Forecast for this week was supposed to be in the same range at 205, but it did increase rather than come down to 214,000 new people applying for unemployment here last week. So this is still a strong number. We've been at multi-decades high. I mean highs in this in regards to that we have such a testament regards to jobs out there that employers are trying to hold on to employees rather than firing them. And obviously, this is a very good sign to what we have. The biggest thing is obviously those who are not really working. Obviously, really need to kind of work on skills because the biggest complaint from employers, we have more job openings than we have positions than people participating, is that people just don't have, they're not coming in with the right skill set to be as a qualified candidate. So that's going to be the biggest thing here. So hopefully we get that rectified and people are back to work, and that we even see that even going lower. So the unemployment rate right now is what, 3.7, 3.8. So fantastic numbers right there. To move it along here, we got inflation data here. This is the consumer price index for the month of September. This is the headline number. So the previous month in August, it went up 0.2%. Forecast was supposed to continue that same trend at 0.2%, and it only went up up 0.1%. Now, however, the year over year had a pretty big drop. It dropped from 2.7% all the way down to 2.3%. So a pretty big drop in that area. Now, when we strip out the food and energy, which creates it's a variable that cannot be controlled, this is a better gauge that the Fed will look at, and we get what they call the core CPI for September. So in August, it only went up 0.1%. Forecast was supposed to go up to 0.2% in September, but again like this one, the previous reading came in only at 0.1%. Now, its year over year remained unchanged. It remained at 2.2%. Now, this is still a very important gauge that we look at. The Fed, however, does like the PC a little bit more. It favors that one when it looks at our inflation data. But again, this is still a good measure because they do kind of, for the most part, go in the right directions and we'll have the same trends and everything. So this gives us some good insight there. Let's move this along. The headline news is down. The stock market again is down. If you saw the stock market yesterday, wow, that was a pretty big drop there. I mean, Dow was down almost 900 points right there. Nasdaq was down about 300. I mean, wow. I mean, that was unbelievable here. And why is this playing out here? It's because if you've been following my charts, especially for a while now, we've been seeing the yields rising and rising, rising. On Tuesday, it even touched like 3.26. These last 2 days, it did pull back a little bit. Now, why is yields are such a big issue here? The yields are an issue primarily because it's a higher cost for corporations, a borrowing cost for them to continue their operations, and then now they have to reevaluate that we're getting back into a more of a normal market. We're not going into overinflated market. We're going into a more of a normal market. If you recall, we've been for a long time been more of a with the Fed accommodating the economy, and now we're getting out of that rut finally after a decade basically of being in that rut. So it's kind of nice to see us kind of taking that steps out of it. The other thing that the investors are concerned about is now that the yields are so high, we may see some investors leaving the equities market and going into the yields because it's got a great rate of return that they're satisfied with, but there's no volatility to it. The volatility is extremely low compared to that of the equity market, so they don't have to worry about losing money in the process. So it may be high enough for them to just move from equities into the treasury department. So again, that means less people bidding on these equities, and that's another concern that they have as well. There's some talk about, still concerns about the China, but we're not seeing so much of that as much. But the biggest things are the yields that are kind of impacting these markets right now here. So let's kind of take a look, see what we're talking about here. Here's the charts here. The bond market, as you can see, we're up. This is showing about 9 basis points. It's been kind of going up a little bit. I've seen even after I did this, it was up about 11 basis points. So we're almost in a position where we'll see a little bit better pricing today. We get this floor support. the drawback being in the position we are, we're in the middle here of these pretty wide range here, and it could go one way or the other way. So we could literally go from one direction to another direction, and without support or resistance, and it could so it has pretty big fluctuations in this market. And as you can see down here in the stochastic market, we've been in this long way since September, almost basically about a month here in this oversold position here. So and we still haven't got back into more of this neutral area here. So at some point we'll hopefully get back into there. We got the 25-day moving average. We talked about this whipsaw leash effect, and we might be seeing that in the process right now as we speak here, especially if we continue seeing the sell-off on the equities markets here. Here's the yields. This dropped below an important floor at 3.20. Now we're down to about 3.16 right now. So we're seeing a drop here. Again, this leash effect here. We're still in an over bought position here on the yields, if you want to say overbought. But in any case, it's we may have this over this position here, and if we can close below this, this will help us out, and this will become a ceiling, a resistance to kind of hopefully keep a little bit of a cap, and could push us down lower to this floor of support at the 3.11 level. That was pretty important. As you can see, we've been below it for a long time until just last week, until it broke above that, and that's when the rates just sharply took a turn for the worse. All right, so that pretty much wraps things up here. I had a pretty interesting comment here I thought I would share here. One of the realtors made a comment in one of my blog posts and mentioned that they just realized that the rates have come up to the 5% level. Yes, they have. We are getting a new norm right now. So if you guys are out there, yes, the rates have climbed. They are in the 5% level range now. And, it's the new norm. So we have to kind of get used to it. And in some areas, it's going to affect more, especially on the jumbo side, where people are, their costs are much higher for affordability purposes. It hasn't really affected the lower level because those are still more affordable. People are kind of flocking more towards those. Those are still moving quite well since we have a lower inventory, and there's still a lot of demand for those. But this is definitely a good time for some home buyers to get in as well. So anyways, if you guys want to see any changes or want any updates to where the market is, come over to Twitter. You can find me at Mike Bjork on Twitter. Hope you guys enjoy the rest of your day. We'll look forward to see you guys tomorrow. Thanks for watching. Bye-bye.